Yields are breaking multi-decade highs just as the AI trade looks most exuberant, and that collision is now driving cross-asset risk. Welcome to vTalkInsight, Allocator's Lens Daily for May 18th, 2026, where we connect equities, rates, credit, currencies, and commodities into one portfolio view. We start with equities, where strong earnings are meeting a much tougher backdrop from rates and energy. In equities, the key tension is between powerful AI-driven earnings and a sharp rise in yields. Indexes that were testing highs earlier in the week are now feeling the weight of higher real and nominal rates. Friday's S&P 500 drop of about 1.25%, alongside volatility back in the high teens, signals growing unease rather than full-blown stress. Earnings remain the main pillar. S&P 500 profits are projected to grow roughly 27% this year, and U.S. large-cap growth is expected to deliver close to 28% over the next 12 months. That strength is heavily concentrated in AI beneficiaries, with semiconductor indices up more than 50% since April. AI chip demand estimated to exceed supply by a wide margin, and major cloud platforms lifting capital expenditure with key hardware providers. Some analysis also argues that, despite headline-grabbing rallies, large-cap growth valuations sit below recent peaks and under 5-year averages. Set against that, leadership is narrow and market structure looks fragile. Only about half of S&P constituents trade above their 50-day averages, and passive ownership is increasingly concentrated in the same megacaps. Sharp moves in some AI-linked initial public offerings and secondary names echo earlier speculative episodes, and there is growing anxiety that the AI build-out could overshoot, leaving excess capacity and pressuring future returns. At the same time, a global bond sell-off, fueled by upside inflation surprises and long yields in the U.S., U.K., and Japan hitting multi-decade highs, has already stalled the AI-led rally. Market commentary flags the U.S. 10-year in the mid-4s, and especially any move toward 5%, as a zone where equity derating could accelerate, particularly for long-duration growth. For allocators, the focus now is on how this earnings power trades in a regime of persistently higher yields and energy prices. In rates, the narrative has moved from higher for longer to outright yield shock. Long-dated government bond yields in the U.S., U.K., and Japan are at multi-decade highs, driven by upside inflation surprises, elevated oil prices, and persistent geopolitical risk. In the United States, 10-year Treasury yields sit in the mid-4s, with market participants increasingly focused on the 4.6 to 4.75% area and the 5% line as thresholds for broader asset price stress. 30-year yields have pushed above 5%, and the long bond has fallen more than 7% in price since late February, pointing to a clear bear market in duration. Market-implied inflation is running well above the Federal Reserve's 2% target, and the term premium is rebuilding as more issuance meets reduced central bank demand. Policy uncertainty amplifies this backdrop. Incoming Fed Chair Kevin Warsh faces inflation above target, internal dissent over how quickly to shrink the balance sheet, and limited ability to offset external shocks from energy and geopolitics. Recent upside surprises in consumer and producer prices make near-term cuts hard to justify, so markets now price a risk premium for renewed hikes, even if that is not yet the central case. At the same time, higher long-end yields themselves tighten financial conditions and may ultimately limit how far the Fed feels compelled to move. UK gilts and Japanese government bonds are reinforcing the theme, with UK long-term yields at their highest since the late 1990s amid political and fiscal worries, and Japan's 30-year above 4.4% alongside the strongest producer price inflation since the 1990s. For multi-asset portfolios, that combination points to a structural shift toward higher global yields and challenges the role of sovereign bonds as a reliable hedge for equity and credit risk. Credit sits in the cross currents of this rates move. On the surface, public markets still look resilient, with corporate issuance heavy as firms rush to lock in funding and demand for high-quality borrowers remaining strong. Major technology companies have raised large sums in a short period, and some U.S. issuers are tapping overseas markets, such as Japan and Switzerland, signaling both deep global appetite and emerging fatigue among domestic investors. Behind that apparent resilience, risks are building. Higher long-end yields steadily raise funding costs and may crowd out weaker credits as governments and top-tier corporates absorb more balance sheet capacity. UK banks are already under pressure as gilt yields jump and sovereign risk is repriced, underlining how quickly moves in government curves can leak into financials. Illiquid credit is even more finely balanced. Private credit funds have faced elevated redemption requests, putting a spotlight on liquidity and valuation practices rather than immediate fundamental deterioration. Within that space, asset-backed structures are drawing attention, while distressed strategies are seen as potential beneficiaries if growth slows or a credit crunch emerges. In foreign exchange, the dominant signal is renewed U.S. dollar strength. Higher Treasury yields, the possibility that the Fed may need to hike rather than cut, and a more cautious tone in risk assets have all pushed investors back toward the dollar as a perceived safe asset. Sterling is on the other side of that trade. The pound is heading for one of its worst weeks in years as UK political uncertainty and fiscal speculation drive a sharp sell-off in gilts. Markets are demanding higher risk premia to hold both UK bonds and currency, and sterling has lost close to 1% in a single session against the dollar, while also weakening versus the euro. Beyond that pair, the broader currency backdrop remains fragile. Higher global yields and unresolved U.S.-China trade and technology tensions hang over more levered or deficit-funded economies. For global portfolios, the question is how far dollar strength can extend before it meaningfully tightens financial conditions for those more vulnerable issuers. In commodities, energy remains the fulcrum of the macro story. Brent crude is trading above $109 a barrel, with an estimated $8 to $10 risk premium versus January as markets grapple with the closure of the Strait of Hormuz and the risk of further escalation around Iran. A prolonged disruption would risk pushing oil toward and possibly above $120, driving a fresh wave of goods inflation later this year and potentially forcing the Fed to contemplate an additional rate hike even as growth slows. There are, however, early signs of adaptation. The United Arab Emirates plans to double export capacity through routes that bypass Hormuz. Saudi Arabia is sending more barrels via the Red Sea, and Canada is progressing West Coast pipelines with broad stakeholder participation. Over time, these shifts could make global flows less hostage to a single choke point and gradually erode today's geopolitical premium. Beyond crude, the AI investment cycle is lifting demand for metals, such as copper and aluminum, while China's continued dominance and export controls in rare earths underline how critical commodity access has become for high-tech supply chains. Across assets, the picture is one of powerful micro-stories running into tougher macro constraints. Equities still enjoy exceptional AI-linked earnings, but higher bond yields and expensive energy are squeezing valuations and lifting volatility. Rates are undergoing a structural repricing to higher levels, which weakens the hedging role of sovereign bonds and pushes more of the risk budget into spread, currency, and commodities. Credit markets remain orderly for now, though heavy issuance, pressure on UK banks, and questions around private credit liquidity argue for close attention to funding channels. In currencies, a stronger dollar and weaker sterling are clear expressions of the yield and political shocks we have discussed. Oil and key metals sit at the center of the inflation and supply chain story, with both upside and downside scenarios hinging on the path of Middle East tensions. For allocators, the near-term watch list includes U.S. 10-year yields around the mid-4s, oil's ability to stay above the low 100s, and any shift in earnings breadth beyond the AI complex. How those variables evolve will determine whether the current adjustment remains a controlled pullback or becomes something more disruptive. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.